Welcome back, everyone. Thank you so much for tuning into this video. If you can please continue to like, subscribe, and share this video. Share it amongst your family and friends. That would be greatly appreciated. And within this episode today, I want to talk about the Federal Reserve. And I'm going to give you all a perspective on its history. I'm also going to explain some hidden truths with the Fed and maybe some things that you haven't thought about that they don't teach us in your average textbook with being in school. And I really want to break down what the Federal Reserve is, but then give you an idea of what they're really designed to do. And I'm pretty sure that the truth may shock you. Now, I explained in episode 19 what the monetary policy is and how the Federal Reserve uses monetary policy to be able to expand the money supply. They're also put in place to help control unemployment. So their goal is to be able to maximize employment within the economy, but also they want to keep inflation down low, and they want to also monitor interest rates so that they can stimulate the economy. Now, the Federal Reserve, for those that may not know, they're essentially the central bank of the United States. And what they do is they help provide the country with a reliable, stable, and a financial monetary system. Now, when it comes to some of their objectives, a lot of times the Federal Reserve, they will either loosen or tighten credit. So with loosening credit simply means is that governments will keep interest rates low so it can encourage businesses and just people to go out and invest, being able to borrow credit so they can be able to keep the economy moving and stimulated. When they're trying to tighten credit, they will often raise interest rates so that way there's no one really borrowing much credit. And that could be that's mainly what are some of their objectives of what they're doing as a independent entity. Now, with the Federal Reserve, I did want to go over the history. Now, the Fed was first created back in 1913 and was signed into law by President Woodrow Wilson. And he gave 12 Federal Reserve banks the ability to print money and ensure economic stability. And some of those Federal Reserve banks are spread all throughout the U.S. You have them in Boston, New York, Philly, Cleveland, Dallas, Kansas City, Chicago, Atlanta. They're in some other cities as well. But throughout the history of the Fed, the constant question is, should they control interest rates, which makes credit more easier to obtain, thus encouraging a stimulated economy and higher employment? However, when this happens, this leads to inflation. Now, the Fed is also put in place to control inflation and slow it down by increasing interest rates. And this plays a vital role in what we pay with credit cards whenever we're borrowing and getting out a loan or even a mortgage. Now, this can also result in slowing down the economy and causing unemployment. Now, right now, the federal funds rate is 0.10%. During the Federal Open Market Committee meeting back in June of 2021, the Fed came out and said that they want to maintain a federal funds rate, which is the interest rate target, at a range of 0 to 0.25%. So they want to keep it between 0 to 25%. And the Fed also stated that they will continue with this target until inflation is at 2% for the long term. Now, keep in mind, inflation right now is currently at 5%. And the Fed explained that they're willing to allow inflation to go above 2% in the short term if it's necessary to maintain maximum employment. Now, the Fed expects inflation to increase to 3.4% this year when the economy recovers, and they expect that it will drop to 2.1% in 2022. So we're still only in July. We still have about 6 more months left in the year. So I'm very interested to see how they're going to react to what the inflation is at right now and how they adjust to that. Now, when it comes to the Federal Reserve, a lot of people feel that they should be eliminated and that they should be abolished. And some of the reasons is because of how the money supply is distributed. There's a lady, her name is Karen Petrou. She's the author of a great book that I've heard. It's called The Engine of Inequality, where she's talking about the Fed and how money is unevenly distributed. And what she discussed in her book is that how monetary policies favor the rich. And when you really think about that, the Federal Reserve was created to benefit the wealthy, and the members of a lot of these Federal Reserve banks that were created, it wasn't designed for the middle class, the low income, the people that are at the bottom of the totem pole, but it was really to help the people that were the ultra rich that already had a monopoly on the economy and just found a strategic way to multiply their pockets. Now, Karen in her book, she also described how her reasoning behind how it's unevenly distributed is that a majority of wealthy people in America have a majority of their money in the financial markets, such as stocks or bonds. A majority of the middle class, they have their wealth in their homes. However, they don't have much equity because they may have an expensive mortgage. It may be well over above their head. Low income and poor class people, they usually don't have any investable assets at all. And they're simply trying to make it day to day. So as you can see, wealth isn't equally distributed. And Karen's viewpoint is that when the Fed uses policies to stimulate the financial markets, it makes it tougher for those at that lower income class that aren't invested at all. So a lot of this is financial education, but also I think that they could do a better job of being able to distribute money in other areas to help those lower income people that may not have as many resources to invest. Now, as I discussed earlier, the Fed has interest rates low at this very moment, and inflation is fairly high. It's at 5%, but I expect it to continue to increase. And this makes it more difficult for people to save because, and even especially for the lower middle class, because the value of their dollars decreases over time. The purchasing value, the purchasing power of their money is constantly being reduced. And the Fed also tends out to bail out businesses in the midst of crisis, especially when the financial markets are in turbulence. And this is another reason why a lot of people feel that the Fed needs to be completely eliminated, because they meddle too much and they are quick to bail out the government. They're quick to bail out small businesses if they go through any type of adversity, and they don't allow the market to discipline themselves. They are not allowing the market to correct itself on its own. And that's why it's very concerned that every time when there's a major crisis, you do have, the Fed kind of intervening. And a lot of these bailouts that happened in 2020 during the pandemic, it mostly went towards companies that weren't as sound as business owners, as entrepreneurs. They didn't allocate enough money in reserves. They weren't proper capital allocators. And they had a lot of debt, with their businesses. So when they were getting all of this free money, it really was to pay off their debt, not really able to help them more get ahead. So I definitely think that when they bail out these companies so quickly, it doesn't allow the economy to find the difference between the great companies and the not so great companies. You have to allow the market to correct itself. So I think that when it comes to the Fed, that's why a lot of people, don't like that organization, because of, just the games of how all of this is a system. They're trying to find a way to continue to keep facilitating their system to make them rich and the wealthy even richer. Now, I wanted to give some hidden truths that may surprise you when it comes to the Federal Reserve. And a great book that I would recommend you all to check out is The Creature of Jekyll Island by G. Edward Griffin. And he really describes how the Federal Reserve, what the true identity of the Federal Reserve is, and what they were made for, what the purpose of it was created for. And a little backstory of how the Federal Reserve came about was back in November of 1910. There were a group of 6 to 7 men that all came together on an island called Jekyll Island. It's off the coast of Georgia, and they all sat down to come up with a strategic plan of how they could create a shared monopoly. Essentially, that's what the Federal Reserve is. And some of those people, I'm not going to list them all, but some of them that came towards that meeting was, his name was Nelson Aldrich. He was a Republican senator. He also was part of a monetary committee that was really focused on bank reform. You also had Frank Vanderlip there. He was the president of the National City Bank of New York, which is now Citibank. You had Paul Warburg, who was there. He was a board member of Wells Fargo, and he was very known for his expertise with international finance, especially with the bank system in Europe. And you also had J.P. Morgan there, and J.P. Morgan was one of the wealthiest financiers in the banking system in New York. A lot of you know J.P. Morgan Chase is what the bank is called now, but a lot of how J.P. Morgan became wealthy was he purchased businesses, he helped reorganize them, he made them become more profitable, and he controlled ownership of those companies, and that's how he was able to really acquire his wealth. And these men at that time represented 1/4 of the wealth throughout the entire world. And when these men met on this island back in 1910, they did it in secret. They didn't want anyone to know that they came to meet on the island. In fact, Nelson Aldrich told all of the members that came to this secret meeting that if anyone asked why you are going on this trip, to say that it was a duck hunting trip. So I thought that was very interesting. They didn't want this secret to get out, and he even told everyone to come separately, one by one, on his private train that rode all the way from New Jersey all the way down to Georgia. Now, it wasn't until the 1930s when these members came out and actually said that this meeting took place. But all the way up until that point, they completely denied it. And the purpose of this meeting, like I explained, was they really wanted bank reform. They wanted to find a way of trying to change the banking system to make it more effective for the members of the Federal Reserve that were elected when it came time to be able to pass the Federal Reserve Act. And the reason why there was a need for bank reform, because they just had there was a financial crisis back in 1907, the Panic of 1907, and a lot of people were losing their money because the banks were unable to hold their deposits. They weren't able to pay back consumers. So Griffin really describes that this meeting was to come up with a plan for these members to become a cartel. And essentially what a cartel is that these bankers and financiers are looking at ways of how they can monopolize and eliminate competition amongst themselves and being able to stabilize their position in the marketplace. That's essentially what the goal of this whole meeting was. And it's very interesting when you look at the history of the Federal Reserve and what they actually were created to do. This is why they wanted more power. They wanted more control on the economy. And a lot of these elites that worked in this banking system at the highest level came together, and they didn't want anyone to know what eventually was passed, and what we know now is the Federal Reserve System. Now, what they also would do to be able to have this shared monopoly is they wanted to have higher profit margins. So one strategy of how they will do this is they'll do price fixing, or they will divide their territory into different geographical areas. So for example, two banking firms may say, I'll take the west and the east while you take the north and the south. So it's very interesting. This was, their whole mentality of what they wanted to do. And it's not what they tell us in the textbook as far as the Federal Reserve is to stabilize the economy, but they really are finding their own strategy to be able to make the wealthy even more richer. Now, another interesting point that I wanted to explain is that the Fed, they work with the government. They work with the private banking system. As I explained, there were 12 Federal Reserve banks, that were divided into these different territories in the cities that I explained. And I'm going to explain exactly how the government benefits from this collaboration with the Fed. Now, the government borrows money from the public when they spend more in comparison to what they take in with taxes, which is their income. So when Congress needs money, they'll issue debt such as a treasury note, a bill, or even a bond. And depending on the length of the maturity, they will essentially lend this money out, and they'll issue this debt with the hopes of that people are going to continue to provide income to the government, so that way they can be able to fund whatever projects that they're working on. And that's essentially what happens with a bond. When you're paying a bond, you're simply providing income to the government while they're taking your income and they're issuing it out as debt, and they're making more money off of your money, and it's tied to interest. So, you got to keep in mind that bonds are essentially debt instruments, and it's really put in place for the government to make money and to profit off of you. So that's why I don't necessarily agree with bonds. I don't think it benefits you as an investor. And a lot of times, with these bonds, the government essentially, they're making lots of money off of debt. That's exactly how this whole system got started. It's just out of, issuing debt and continuing to pass it along to more and more people. Now, another thing you have to keep in mind is that with inflation, the amount of money that you loan to the government as a bond may not be the same amount that you'll get back at the end of that maturity date. So when the government needs more money, guess who they go to next? They go to the Federal Reserve, and the Federal Reserve, they can print money at ease. They can print infinite amounts. It doesn't matter. They can provide any amount that the government needs. And this is the main benefit of why the government works with the Federal Reserve. They also don't want the public to know about inflation, which is a hidden tax. And they don't want you to know that this is costing you anything. So the Fed indirectly has an impact on your savings. They are controlling interest rates, and when they are low like how they are now, that leads to inflation, which could also mean higher taxes that will be charged from the government, because when there's higher taxes, that's the government providing a sign letting you know that they're going to take money. They're going to take money from you as a just a regular citizen, and you're going to have to pay them back to help them fund their other initiatives. So they raise taxes. And the purchasing power of the dollar just continues to just dilute over time, because the Fed is printing more money. The government, they are in it because they're getting money from the Fed. And, it's just really interesting to think about how this system works. And that's why I recommend you want to have a healthy balance between investable assets and emergency funds. And the banking system essentially profits from the Federal Reserve, because when the banks receive money from the public, they also issue your money as debt. So you not only have the government that's issuing debt as, a bond, you also have student loans, you have mortgages, all of these different ways of how they're issuing debt. The banks are in it too. So they're part of the whole system as well. And when we go to the bank, we're either depositing money, we may be withdrawing it, we may be borrowing credit. And the reason banks are able to lend credit out is because they are using the funds that are being deposited from other people that are coming into their bank. And they issue their money as debt, and they receive interest on it as well. So this is how money is created. That's truly economics 101. The banks profit from this because they use other people's money plus interest on the credit that they issue, and they continue this revolving system by issuing debt constantly. So this is the system, ladies and gentlemen. I know you may be shocked, and you may be thinking like, I never knew that this was possible, or that the government, the Federal Reserve, and our private banking system has so much control on our wealth. But they really do. And I think for us, education is powerful. You have to empower yourself with education, informing yourself, and being aware, having self-awareness of what's going on in our economy, so you can be able to properly prepare with navigating your assets so you can battle against this. Because the only way that you're going to be able to fight against inflation, fight against higher taxes, is putting your investments into assets that maybe have a hedge against inflation. You want to look at having hard assets such as real estate. You want to have some gold. You want to have silver. You want to own your own business. And I think that you don't want to play in the hands of the government, the private banking, or the Federal Reserve System. You have to understand that when interest rates are low like how they are now, rather than using debt to put yourself more in a deeper situation, to buying more liabilities, acquiring more credit card debt, you have to leverage debt to your advantage. So I would say that you want to use debt to be able to buy more assets. And when you think about it, that's what the wealthy people do. That's what the government is doing. That's what the Federal Reserve is doing. These private banks, they're using debt of how this whole system was created back to all the way when this was passed in 1913. And they are issuing debt, and they're just continuing the cycle. And that's how they're able to profit and make more and more money. So why can't you do the same thing? So don't feel that you can't use debt. There is a such thing as good debt and bad debt, but leverage it to your advantage. And I think that, like I said, you got to have a balance between your savings and your investments. And you don't want to store all of your money in the savings account, because the purchasing value of the dollar is decreasing day by day. You have to think about inflation, like I talked about throughout this video. And I think that if you have paper assets such as stocks, have some digital assets with cryptocurrencies, this will allow you to have more financial independence and more control of your assets. So thank you all so much for tuning in into this episode. I'm definitely going to put all of my information in the show notes with my link tree, where you can support my Patreon page. And I also will put the books in the show notes that I've described throughout this episode. And continue to like, subscribe, and share this video. And I hope you all have a great day.